Hello, everyone. Good afternoon, good morning, good evening. Um, Thank you for joining me, and hopefully, you'll get a chance to watch this if you're not watching live. I just wanted to answer any questions you might have. If you're new to Google Hangout, if you scroll or hover over, you should see a Q&A button, and you should be able to type your questions below, and I will answer them until you have clarity. So feel free to do that, or you can at me on Twitter. But I think this Q&A box will be quicker since it's right here while I'm broadcasting. Um, yeah, so let's just go over the different currency pairs. Let's start with the pound. Um, so as you guys know, I've been waiting for the pound to pop all week, actually for what, maybe 2 or 3 weeks now, all month. And we've been getting a lot of this action here that's been capped by 135, and rightfully so, as you read in this week's report. But this move to the downside after last week, 2 weeks ago, um, has been holding support here. And so I'm just waiting for this to move higher, thinking that we're going to get this bigger correction. I'll move us here into 139, 136, 40. And we just haven't, we haven't, but we've been supported. So after FOMC gave us this nice pop, kind of bailed us out here. If we were caught short here last week, I know I was, and I've been holding this sucker short through, negative 100 or so pips as it's been bouncing along here. Finally got bailed out when we got the pop yesterday after FOMC to 132, almost 132.50, but to a high of 132.48. This this retracement back seemed to me this morning like an opportunity to add to my long position. But when we got this move that breached the 61.8 level, we got to close below it. Even this pop here after to about 131.50 to me signaled and was an opportunity to get short. I do think that the pound dollar now is likely to go lower because we did not sustain the rally after the FOMC. In fact, it was actually read as quite bullish of a statement, despite the weakness in the dollar, just based on the reaction that we didn't get a raise in interest rates. So dollar weakness was not because the FOMC was dovish in any way or, suddenly pessimistic, but just because the market is still waiting for this interest rate hike of 2016, and we haven't gotten it. And so in every meeting is quote unquote live, and markets are waiting for this interest rate hike. And when we don't get it, there's extreme disappointment. That's what this reaction was into the highs. And that wasn't confirmed until this later this morning, where we got this breach of the 61.8 when we fell below the 132.29. For you all want to see it. So we got this breach and a close below it. And so now any pops higher, any moves higher are ripe for selling. And in particular, we're likely to see a move that takes us back to 132 or 131.80. I like the 50% Fibonacci level for the cable. And so I got in here about 130. Here we're at 146 with a quarter size. So if you take a typical standard lot, I got in with just a quarter of that size, with 2,000 or 20,000 units out of 100,000, standard lot, just really getting in small. And if this was going to, continue lower, but what was likely going to happen, and just looking at the commentary in the markets right now on feeds and Twitter, is that if the market gets a strong GDP number, And actually, there's some thinking that the Federal Reserve statement was because they're anticipating that strong GDP, that the dollar is going to rally and we're going to see a sharp drop in the pound dollar. And that actually, that that narrative actually jives very well with the price action that we've seen, where we're getting capped at 135. We're not able to make it to these Fibonacci levels when we're looking at the retracement on the Brexit drop. And it's very likely that we do get some movement to the downside that breaks below 130, 127.89 lows. And that would be extremely bearish, and right now price action is already bearish, so that actually supports that narrative. So what we're looking for is just moves that take us above 150, 150, and just looking to get short 131.80, 132, and ahead of tomorrow's release. Now, if the GDP out of the US is weak, watch this move to the back to the upside and above $1.3250. And if that happens, I'm sure we'll see a rally. So a lot is depending on Friday's GDP release. And if you're more conservative, I would just wait until the release. Don't get in at all. Stay flat. You probably got stopped out at break even on a long thanks to this drop. I wouldn't get back in long. Like I told you, I got in short, but I got in short really tiny size, not at my full size at all. So, and I have a stop above $1.32. So don't risk anything. If you're flat, stay flat would be my suggestion. And then let's see how the market behaves tomorrow. Euro pound is really what's signaling to me more pound weakness. What we might see more pound weakness across the board. And the fact of the matter is that when we saw this breach, the 83 support level, which was also the 50% FIB, we didn't get close below it. But to me, it felt like it was enough of a move that we would see continuation to the downside, and we really haven't. We've gotten a lot of choppy range bound action between 184 on top and 182 on the bottom, and these jabs below it. But these jabs have been higher lows, and now we've been getting higher highs. And this break today above 84.30, which had really been capping the rallies for the last 2 weeks, actually gave way today. To me, that's a signal to buy. And this is no longer a bullish scenario where we would get a Fibonacci reversal level, because what we're seeing is the weekly chart what we're seeing is that, is that this is the Fibonacci level that is in play now. Lost my levels. Okay. So we're looking at this. There we go. This is the Fibonacci level that's in play here, where we get this hold at the 38.2, which is very, very bullish for the euro pound. And we're going to get a continuation to the upside. We'll probably see new highs in the next coming weeks, particularly if the euro continues to gather strength. And we're seeing euro strength pretty much across the board. So the euro pound is to us what should be our kind of pound barometer of strength or weakness, and right now it's signaling more pound weakness in the weeks ahead. And if nothing else, we can definitely be assured, or some confirmation after today's price action, that we can short the pound versus the euro by going long. And any dips coming back into the support level, you can see now we're holding above 84.30, right? So this is really very bullish price action, and we're seeing that the drop back in here is held, the drop back here is held, the recent drop right now, as we're talking together, is holding to anything that. But don't be surprised if 84.30 gives way, and we see a fall back to the 84 level. So 84.11 should hold. 84 most definitely will likely hold, given that the euro pound right now has flipped bullish. And because it's flipped bullish, it is signaling to me that we will see some pound weakness. Now, it is also likely that we see the euro pound rally alongside of a pound dollar rally, and that is if we see overwhelming dollar weakness. And it's essentially what we saw yesterday, right? We got the pound dollar to rally on the FOMC, the weakness after the FOMC, and what we saw was the euro pound rally as well. So keep that in mind as well, because if we see that movement, which is really an inverse of each other, the pound dollar going up alongside of the euro pound, what we're seeing is the euro dominating flows because of dollar weakness. So dollar weakness will rally the euro dollar, which will drag up the euro pound as well, even if the pound dollar is also rallying. So take note of that relationship that might be coming on in August, that we might start seeing that the pound dollar actually rallies alongside of the euro pound. And it really will depend a lot on what kind of number we get tomorrow. So look out for that. I'm more confident in a euro pound long than I am a pound dollar long as we sit today headed into that GDP release. Okay, moving into some of our other cross-currency pairs in the pound. Kiwi, one of my faves, but it's definitely a volatile pair. You really want to make sure your entries are good here. We were looking at this Fibonacci buy level here, and 85 has been proving to be great support, not just last week, but also this week. We've seen it time and again. And this has been choppy, and we've been pretty much range bound between 188 and 185. This week, though, we've been really stuck between $1.86, right, and $1.85. So if you're long from $1.85, as was outlined in this week's report, volume 71, I will go ahead and close out your longs here at 186. Take your profits ahead of what I believe will be pound weakness. And so if we move out a little bit here, we can see that this move to $1.90, though it did breach the 61.8. We never got, again, no closes above it. That really would signify a reversal back to $1.92, or really, back to $1.98, right? Given this Fibonacci level, if we look on the bigger time frames and just look at the entire Brexit drop, we can see that 88.50 level, right? And then that 190 is really just playing right into those Fibonacci sell zone. And if we just take the entire bearish wave here, this is why I was so bullish, thinking that we would get a lot more retracement. But again, not reaching these bigger fibs keeps this pound Kiwi quite bearish, quite frankly, and that we eventually, if we do get this pound weakness, as is being signaled, we should start to see a move again to the downside, especially with this weekly close below 177. I believe that we will see more weakness in the pound Kiwi, and it's a matter of timing. With these summer doldrums, we've just seen a lot of choppy action. Okay, so I'm flat the pound Kiwi now. No real desire to get back in unless we get a close below $1.85, and really, what many might think is late, but $1.81. I'm sorry, $1.82. A move below that really signals a reversal, and though it might seem late from these highs, $1.82 to 177 is a nice 500 pip move, and we can wait and get that confirmation if we were to to be guaranteed 500 pips and not have to risk 500, because we're trying to get short here at 186, and it might move higher to 190, 192 from here because of the support at the Fibonacci level. So I'm never really about the guessing game, trying to always get a confirmed move and minimize risk. So Pound Kiwi, I would say just to take your profits here, or tighten your stops past break even, because we're well past 185, and see again how we get, what reactions we get tomorrow. Yeah, pound yen. A lot of people looking for Bank of England. I'm sorry, the Bank of England, the Bank of Japan. Later on this evening, that's going to be a big one, and quite honestly, they could go either way. It's completely 50-50. I am flat. The pound yen, not, again, I don't like guessing games, but because we did suggest at the top of the week to go long the pound yen at 136 at this fib level. We got that fill, and our stops should at least be tightened. If you didn't take profit here at 140 on that spike move to the highs, and you're still long, I would get out. I would take profits here, or at least, again, at the very least, tighten those stops past break even, so that you can, if you do get stopped out on a Bank of Japan surprise, at least you'll come out with some pips. But I do think that the pound yen will be, I think the Bank of Japan will be a bearish event for the yen, and that this has the potential to go much, much higher into the 148 level, just given what Shinzo Abe has said a couple weeks ago with his full commitment to monetary accommodation, monetary easing, even as just the prime minister. Not even it wouldn't be surprising to me if he influences Kuroda and company to enact more easing to support the Japanese economy. So I think the BOJ is a bearish event, but it's very quite likely they do nothing given the massive amounts of easing they already have in place. And if they do nothing, we will see a drop in the pound yen on the back of Japanese yen strength. That could very easily give us a reversal situation and move us right back to these lows. So again, my advice to you guys, and what I've done is just, well, I've gone flat, and just, we'll wait and see what the Bank of Japan has in store for markets. Pound Aussie has been real choppy. We've gotten fills at that 174 because of this 50% fib, and we got a failed high here, which, as you know, if you're longtime readers, you know that this means that this failed high here on this Fibonacci move means that we're going to get lower lows. So again, if you got long here and you're struggling with this 175 level, because we're struggling with it, I would take profits here at 175, and again, wait. To me, I think we're going to get pound weakness, and so I think on any move above 175 is an opportunity to go short for a move that takes us back to the 170.40 lows, and quite frankly, a continuation of the move to the downside. We're still getting a very pound bearish market with on the bigger time frames, these moves not able to retrace fully. When we get this kind of retracement that doesn't reach these Fibonacci levels, the trend is very, very strong, and this bearish trend is a strong one, and doesn't look likely to let up with the way that these corrections have been kind of short-circuited. And so then lastly, the pound CAD, which has actually been doing the best as far as some of these pairs have been concerned, in trying to really move and correct more to the upside. It's also, looking on the bigger time frames, has just been having trouble at this 174.50 level, not really even able to make it to 175. And really, what we've been targeting in the Quid report in the last couple of weeks is this 176 fib level. So coming back in, we're just, took long. We took our profits on the longs that went from 171 and 172, and another hold of the 74.50 level even on today. on this week's price action to the upside. So again, taking profits on longs and waiting to see. We also have a GDP number release coming out of Canada tomorrow, and Canadian economy has been doing quite well. A strong number there will see the pound CAD drop on the back of Canadian dollar strength. And so I'm more biased to see that this actually does fall from these current levels at $1.73 back below 170. So again, it's one of these, this action above 170 has been bullish, but 174.50 has been capping us, and you can see that that's just that 50% Fibonacci level at 74.32. We've been capped there, and there is perfectly reasonable logic to believe that this is actually about to make a move to the downside. And so as we head into the weekend, we're really going to start to position for more pound weakness across the board, and it's going to be choppier in some pairs than others. But I think that the correction to the upside has come to an end, and depending on Friday's releases, we're really going to see that weakness in sterling accelerate to the downside. So your best bet for pound weakness is by far the euro pound, and you can see we came right to 84.30 as we were talking, and we're still holding. Here we are at 84.35. It's opportunity to get long, really, but with bigger, as you build a position, as we get this drop right back into 84, which is is very likely, but this is very bullish price action, which is very, very bearish for the pound. So let me pop over and see. We had no questions. So, if we have questions after the broadcast or about the broadcast that I didn't answer, let me know. Until then, happy trades.